In this lecture, we will study discounted cash flow valuation and terminal value. DCF valuation is one of the most important tools in finance because it connects the value of a business to the cash flows that business is expected to generate in the future. The basic idea is simple. A dollar received in the future is worth less than a dollar received today. Also, cash flows that are risky should be valued using a higher required return than cash flows that are safer. But corporate valuation is more than just discounting a few cash flows. A company is usually a going concern. It may continue operating far beyond the years we can forecast in detail. That is why a DCF valuation usually has two major parts. First, we estimate the value of cash flows during an explicit forecast period. Second, we estimate the value remaining after that period, which we call terminal value. This is where DCF becomes both analytical and judgmental. The calculations may look precise, but the answer depends heavily on assumptions about growth, margins, reinvestment, risk, and competitive advantage. So, throughout this lecture, remember one key principle. A DCF model is only as good as the economic story behind it. Let's begin with the overall structure of a DCF valuation. In a standard enterprise DCF, we value the operating business. We forecast free cash flow to the firm during the explicit forecast period, discount those cash flows back to today, and then add the present value of terminal value. The explicit forecast period captures the years where the analyst makes detailed year-by-year assumptions. These assumptions may include revenue growth, operating margins, taxes, capital expenditures, depreciation, and working capital needs. The terminal value captures the value of cash flows after the explicit forecast period. In many valuations, terminal value is a very important part of enterprise value because a business may continue generating cash flows long after the detailed forecast ends. Once enterprise value is estimated, we move from enterprise value to the value available to common shareholders. This requires adjusting for financial claims and non-operating assets. Debt, preferred stock, and non-controlling interests reduce the value available to common shareholders. Cash and non-operating assets increase it. Finally, common equity value can be divided by diluted shares outstanding to estimate an implied value per share. The order matters. First, value the operating enterprise, then adjust for claims and non-operating assets. Let's now talk about the explicit forecast horizon. The forecast horizon is the period during which the analyst forecasts cash flows year by year. The right horizon depends on the economics of the business, not just on convenience. A useful forecast horizon should be long enough for the company to approach a more stable condition. The firm does not have to become perfectly mature, but by the terminal year, the analyst should be able to make reasonable, long-run assumptions. Those long-run assumptions include growth, margins, reinvestment, and risk. If those items are still changing dramatically in the terminal year, then terminal value may be based on an unstable foundation. A longer forecast horizon may be appropriate when the company is young, growing rapidly, entering new markets, launching major products, restructuring operations, or moving through a business cycle that is not representative of normal conditions. A shorter forecast horizon may be appropriate when the company is already mature, stable, and earning margins and returns that are close to sustainable long-run levels. The terminal year deserves special attention. Terminal value should not be based on a year with temporarily high profits, temporarily low investment, unusual working capital movements, or distorted cash flow. The terminal year should represent a normalized year. In other words, it should be a year that can reasonably support the long-run assumptions used in the valuation. Next, we need to understand free cash flow. In an enterprise DCF, the usual cash flow measure is free cash flow to the firm. This is the cash flow generated by the operating business after operating taxes and required reinvestment, but before payments to debt holders or shareholders. The background visual shows the common formula. The important idea is that free cash flow is not the same as accounting profit. Accounting profit includes accruals and accounting rules. Free cash flow focuses on cash generated by operations after the business has made the investments needed to support its activities. A practical DCF forecast often begins with revenue. The analyst forecasts revenue growth, estimates operating margins, calculates operating taxes, forecasts capital expenditures and depreciation, estimates working capital needs, and then arrives at free cash flow. The key question is not simply whether cash flow grows. The deeper question is whether growth requires reinvestment and whether the return on that reinvestment exceeds the cost of capital. This is one of the most important lessons in valuation. Growth by itself is not automatically good. A company can grow and still destroy value if growth requires too much capital or earns weak returns. On the other hand, a company with moderate growth can create significant value if it earns strong margins, uses capital efficiently, and has durable competitive advantages. So when you forecast free cash flow, always connect the spreadsheet numbers to business economics. Free cash flow is driven by four broad economic forces: growth, profitability, reinvestment, and risk. Let's take them one at a time. Growth tells us how quickly the business can expand. Higher growth can increase future revenue, but it creates value only when the growth produces adequate returns on new capital. Profitability tells us how much of revenue becomes operating profit. Sustainable operating margins matter because they influence operating income, after-tax operating profit, and ultimately free cash flow. Reinvestment tells us how much capital the company needs to support growth. Capital expenditures, technology investments, capacity expansion, inventory, receivables, and other working capital needs can all reduce free cash flow in the near term. Risk tells us how uncertain the cash flows are and what return investors require. Higher risk increases the discount rate, and a higher discount rate lowers present value. These four drivers are connected. We should not forecast them independently as if they have nothing to do with one another. A high growth case may require more reinvestment. A margin expansion case may require evidence of pricing power, cost advantages, or scale economies. A lower risk case may require more stable demand, less leverage, or a stronger competitive position. The visual on screen also shows the relationship between growth, return on invested capital, and reinvestment. The message is powerful. Firms usually cannot grow indefinitely without reinvesting. Value is created when reinvestment earns returns above the cost of capital. Now we move to terminal value. Terminal value is the estimated value of the business at the end of the explicit forecast period. It represents the value at that future date of all cash flows expected after the detailed forecast ends. Terminal value often accounts for a large share of enterprise value. This does not automatically mean the valuation is wrong. A going concern may reasonably be expected to generate cash flows for many years beyond the forecast period. However, it does mean that the terminal value assumption deserves careful attention. There are two common approaches to terminal value. The first is the perpetuity growth method. The second is the exit multiple method. The perpetuity growth method assumes that free cash flow grows at a constant rate forever after the explicit forecast period. This method makes the long-run growth assumption explicit. The analyst must decide what growth rate is sustainable over the very long run. A reasonable perpetual growth rate should be sustainable indefinitely. For a mature company, it is often expected to be near or below the long-run growth rate of the economy in which the firm operates. A company may grow faster than the economy for a while, but it cannot grow faster than the economy forever without eventually becoming unrealistically large. The perpetuity growth method works best when terminal year free cash flow is normalized and the business has reached a stable relationship among growth, margins, reinvestment, and risk. The second common approach is the exit multiple method. The exit multiple method estimates terminal value by applying a valuation multiple to a terminal year financial metric. The background visual shows the basic structure. This method is often used as a market-based cross-check because it connects the terminal value to observed valuation multiples for comparable companies or transactions. But it is important to understand that the exit multiple method does not eliminate assumptions. It simply packages many assumptions inside the selected multiple. A valuation multiple reflects expectations about future growth, profitability, capital intensity, risk, interest rates, and market conditions. For example, a company with stronger growth, higher margins, lower risk, and better capital efficiency may deserve a higher multiple than a weaker company. but that judgment must be supported by business logic. One useful diagnostic is to convert the exit multiple into an implied perpetual growth rate. If the exit multiple implies an unrealistically high long-run growth rate, the terminal value may be too aggressive. If it implies a negative or implausibly low long-run growth rate, the terminal value may be too conservative, or the terminal year metric may not be normalized. The best practice is not to blindly choose either method. Use both methods thoughtfully. Let one method challenge the other. If they produce very different conclusions, investigate why. Let's now focus on discount rates and consistency. The discount rate converts expected future cash flows into present value. It should reflect both the risk of the cash flows and the claim being valued. This is one of the most common places where valuation mistakes happen. Free cash flow to the firm should be discounted at the weighted average cost of capital. That produces enterprise value. Free cash flow to equity should be discounted at the cost of equity. That produces equity value. Dividends should also be discounted at the cost of equity when valuing common shares. Debt cash flows should be discounted using a cost of debt appropriate for comparable risk. There are other consistency principles as well. Nominal cash flows should be discounted at nominal rates. Real cash flows should be discounted at real rates. Cash flows in a given currency should be discounted using a rate appropriate for that same currency. After-tax cash flows should be discounted using after-tax discount rates. Also, free cash flow to the firm excludes interest expense. Why? Because financing costs are already reflected in the WACC. A common mistake is to discount enterprise cash flows at the cost of equity. Another mistake is subtracting interest expense in free cash flow to the firm and then discounting at WACC. That double counts the cost of debt. Good valuation requires clean matching. Cash flow, discount rate, and value conclusion must all belong together. Once the free cash flows, terminal value, and discount rate are specified, the valuation mechanics are straightforward. The present value of the explicit forecast period cash flows is calculated by discounting each forecasted free cash flow back to today. The present value of terminal value is calculated by discounting the terminal value back to today. The background visuals show the formulas. Enterprise value is the sum of these two parts, the present value of forecast cash flows and the present value of terminal value. Some analysts use a mid-year convention when cash flows are assumed to arrive throughout the year rather than at year-end. The convention can affect valuation, but the key principle is consistency. Timing assumptions should be applied deliberately and explained clearly. Now, how should we interpret the valuation? A DCF valuation is not a single fact. It is a conclusion conditional on assumptions. The best use of a DCF model is not only to produce an estimate of value, it is also to reveal which assumptions matter most. Ask good diagnostic questions. How much of enterprise value comes from terminal value? Are terminal year margins realistic? Does the forecast assume growth without enough reinvestment? Is the implied return on invested capital sustainable? Does the discount rate match the risk of the cash flows? Also, remember the difference between value and price. Value is based on expected cash flows and required returns. Price is what someone pays or what the market quotes. A thoughtful DCF usually produces a valuation range, not just a single point estimate. Let's finish with sensitivity analysis, common mistakes, and managerial interpretation. DCF valuations are especially sensitive to assumptions that affect long-run cash flow and discount rates. Growth, margins, reinvestment, and risk are the major areas to examine. Higher growth may increase future revenue, but it may also require more investment. Higher margins may increase free cash flow, but they must be supported by competition, pricing power, input costs, and customer retention. Lower reinvestment may increase cash flow today, but it may also weaken future growth. Higher risk increases the discount rate and lowers present value. Sensitivity analysis should not be a mechanical exercise. It should be tied to business logic. Now consider common mistakes. Do not mix cash flow definitions and discount rates. Do not double count financing costs. Do not use unrealistic terminal growth assumptions. Do not ignore reinvestment needs. Do not base terminal value on an abnormal year. And do not treat a point estimate as certainty. The real power of DCF valuation is managerial. It connects operating strategy to financial value. A good DCF model helps managers evaluate acquisitions, divestitures, business units, strategic plans, and operating improvements. It also helps communicate the financial logic behind a recommendation. The most valuable DCF models are not necessarily the most complicated. They are the models that make assumptions transparent, connect those assumptions to business economics, and help decision makers understand when value is created or destroyed. Thank you for joining me today. I hope this lecture helped you understand discounted cash flow valuation and terminal value more clearly. I will see you in the next video.